Cost volume profit analysis. So in the managerial accounting, so this is also one of the important analysis that we should know. It is clear from the name, the cost, volume, and profit. There are three words. The cost means just expenditure. So volume means the quantity, and the profit here is how much profit that we earn. For example, selling price minus cost is equal to the profit. Now analysis here is what it shows. It shows at the modification or changing in the quantity produced will affect the cost and profit. This is the analysis that we need to understand in this topic. So how and when to apply the cost volume profit analysis framework, and we'll explain the analysis. Compare and contrast the absorption costing and variable costing both. Okay, so now we can see that the basics of cost volume profit analysis is the contribution margin income statement. So what is the contribution margin? We know that when there are two kinds of cost, the variable cost and the fixed cost. When the variable cost is deducted and the rest of the money before deducting the fixed expenditure is known as a contribution margin. So what is that? You can see on this contribution margin format on the left hand side. Sales revenue we have less the variable cost of goods sold and variable cost of SG&A, selling and the distribution expenditures. And here we can see the contribution margin. Now after the contribution margin, if we deduct some of the fixed expenditure, right? So fixed cost of goods sold means cost of goods sold, for example, from the 10,000, 8,000 units were sold. What is the cost of those 8,000 units? Take an example of a chair. So what are the cost of those 8,000 chairs, right? So what is the fixed cost here? We will subtract. And selling and administration expenses, that also that we are going to subtract from here. Now on the right hand side, we can see that this is the gross margin format. So this is this kind of format is used in financial accounting and not in managerial accounting. Here we have sales revenue less all the variable and fixed cost of goods sold, and so we have here gross profit with gross margin. Selling and the distribution expenditure, administration expenditure, right? So which is known as non-manufacturing expenditure, we will subtract here. Then we come to know about what is the net operating income. Now the basic of cost volume profit analysis, that is the contribution margin format. So what the contribution margin format is? So this is the cost are grouped according to the cost behavior. The cost that change and is upon to the change in the volume of activity, right? That is the variable cost which we already studied. And the cost that remain the fixed, whether the activity change, mean whether the quantity change or not change, right? Whether the sale or means the production in units has increased or not increased. It's not going to affect the fixed cost, just like a rent of the building and a fixed expenditure, any fixed expenditure. So this is the cost behavior, and the cost drives are the production activity for the variable product cost, and sales level for the selling and general and administrative cost. So all these expense S, G, and A, right? So these are the cost drivers. So cost driver means the cost will change when the activity change, right? So product cost include only the variable cost element. That is explained here: direct material, direct labor, and variable manufacturing overhead. I'm talking about the manufacturing overhead, not any other expenditure will be calculated. Fixed manufacturing cost is also expenditure, and this expensed as a period cost without being assigned to the product. So we are not going to assign this cost to the product. We are not going to calculate. We are not going to subtract it. The cost of inventory of the product will not include in the fixed cost of manufacturing. Units in inventory will carry only variable cost of manufacturing. So ultimately, again and again, the same thing is repeating, right? So units of inventory, the closing stock also that we will calculate, that will carry uh, only the variable cost of manufacturing. So margin is calculated from the sales revenue after charging all the variable against the revenue. So revenue minus all the variable. The result will be contribution margin. Fixed costs are deducted from the contribution margin to find out the NOI, that is NOI or OI, operating income. So net operating income from the contribution margin approach need not equal the net operating income from the absorption costing approach, because here the net profit will be different and the net profit will be different from the other approach. So we have two different approaches. Now look at this. This is absorption cost of ferment, and this cost are grouped by the functions, like maybe manufacturing functions or maybe the non-manufacturing functions. Product cost include product cost includes all manufacturing cost, variable manufacturing cost element plus the fixed cost per unit. So this is the most important point that we have already discussed in one of the example before, is plus fixed cost per unit. So the fixed cost must be converted to a per unit basis to assign these costs to units in production. Units in inventory will carry the full cost of manufacturing. The full cost means the variable as well as the fixed cost per unit. Margin is calculated from sale revenue after deducting the cost of goods sold. The result is called gross margin. The key is that the selling and administrative costs are not deducted when computing the cost gross margin, not gross profit. Selling and administrative costs are deducted from the gross margin to find out to determine the absorption costing operating income. The net operating income, the OI, from the contribution margin approach need not equal to the net operating income from the absorption costing approach. So both approaches are different, contribution and absorption. So now you can see that the basis of the cost volume profit, CVP, right? So that analysis is the two bases. The first one is the contribution margin and second one is the absorption costing format. So the contribution margin income statement can be used to see the profit that will change when different operating decisions are made. It is the ideal tool to use for decision making and for internal reporting on the profitability analysis. So it means that CVP contribution, this is the contribution margin, the CM specifically, is a very important tool. Why this is very important? The important because that the selling price or sale minus the variable is equal to the contribution. Whatever the contribution that we have made at the time of making or manufacturing of the product, right? Maybe a number of chairs, right? So that is the contribution that we have made. So what is the contribution margin? By our contribution, by our addition, adding or something, by our efforts, what is the margin? Otherwise, the fixed cost is not included here. We are not going to deduct any fixed cost. The reason being fixed cost is fixed, irrespective of your efforts. You put more efforts or less efforts, rent of the building will remain the same. So that's why this contribution margin is a very, very important and the very important tool to know the some decision making process and to know the what exactly the profitability is there. On the other side, absorption costing format is very good for external financial reporting, where the goal is to record the cost and expenses and report them to the company's the stakeholders. Stakeholder may be the public, maybe the shareholders, bankers, investors, suppliers, customers. All these are the stakeholders. Now look at the example here. Consider the following information developed by the accountant at the wind bicycle company. For example, the total 500 bike sale is the $250,000, and the cost is 500 because 5 into 5 is the 25, right? Less variable expense is 150 and $100,000. The 1 lakh is the contribution margin. Now we know that the 200 unit, $200 per unit is the contribution margin. Now fixed expenditure we have 80,000 and net income is 20,000. So we will be having a net profit of $20,000. So we have subtracted the fixed expenditure over here. Let's see, for each additional unit wind cell, like 200 profit will they get, right? So 200 more in contribution margin will help to cover the fixed expenses and profit. So what is the meaning of this? This is very, very important, I'm telling you. $200, we know that this is $200 the contribution margin. So $200 is the contribution margin. It means per unit. It means if you put some more efforts and produce more unit in a month, then that will be exactly the profit. That will be 100% profit. The $200, that will be the profit for 1 unit. If 2 unit, then $400. If you are going to produce 100, so 100 into 200 is a 200,000. So that will be the profit. So next we have each month wind must generate at least $80,000. It means this company must have this much of profit, like $80,000. So at least $80,000 they need to have. They need to have to cover this one, right? So once they will be having $80,000 only till the covering. So it means that will be the break-even point. Let's take an example here. For example, that this is the 400 unit. If the wind company is going to sell in a month, it will be the operating at the break-even point. It means operating means like manufacturing, then doing work or running their own factory. So the operating at the break-even point, no profit, no loss. So this is the zero income. It means the company is manufacturing 400 bikes and just covering all the expenditures. That's it. But net profit is zero. Now, so what happened if the wind sell 1 additional unit? Like instead of 400 is the 401. So 200, that will be the profit. If it is 2, then 400. If it's 3, then it will be 600, right? So 3 multiplied by 200, that will be the profit, right? So in this way, the company come to know at least how much unit we need to produce so that there will be no profit and no loss. This is the variable expenditure that we deducted. Now, if we talk of the break-even point, the break-even point can be defined either as the point where the total sales revenue equals the total expenditure. So total sale is equal to total expenditure. I'm talking about the variable and fixed both. Or we can say at the point where the total contribution margin, which is equal the total fixed expenditure. Yes, this is also right. When the contribution margin, you can see that the contribution margin was $100,000, right? 250 minus 150 is equal to 100, right? So $100,000, that was the contribution margin, CM. When CM, contribution margin, is exactly equal to the fixed cost, right? So that is also true. This is the break-even point, because that $100,000 minus $100,000 fixed expenditure, then zero will be the net income. It means neither profit nor loss, means break-even point. So it means a contribution margin is equal, when contribution margin is equal to fixed cost, this is considered as break-even point. Okay, so now look at this, the contribution margin ratio. What is that? The contribution margin ratio is the contribution margin as a percentage of sale. Yes, so $100,000 divided by $250,000 is like 40%. It means 40% of the sale is a contribution margin. Is a variable. When the sale increase 40% of the sale, that will be the contribution margin. Now, contribution margin ratio. At Wind, each $1 increase in sales revenue result in the total contribution margin increase of 40 cents. This is the meaning of this formula that we calculated. This is the meaning of this formula. CM ratio explains that at Wind, each $1 increase in the sales volume. It means sales volume is increasing. Sale is increasing. Even if $1 is increasing, it means the contribution margin is also increasing by 40 cents, because this is the 40%. If sale increase by 50,000, what will be the increase in the total margin? What will be the increase in the total margin, right? It's very simple. If we say 40%, then 5 into 40%, right? So that should be 20%. Let's see what it's saying. Okay, so from the 400, like 50,000 increase in the sale revenue. So the sale revenue has increased. Sales revenue increase in the sale revenue. So sale revenue has increased here 250,000, right? So it means 100 bikes are already sold. So 150 is what? This is the variable expenditure, and we can say it's the contribution margin minus fixed cost is the 20,000 is the net income. So if we calculate ratio, no need to do any calculation. It's a very simple and straightforward, right? So we can calculate on the basis of this, right? So 250,000 that we have sale here, the 50,000 increase in the sale volume, which will definitely result in the net income of 20,000, which is explaining here. So increase in the CM, increase in the net operating income. Now, this is one example in front of you. This example saying the coffee clutch is the espresso stand in the downtown office building. The average selling price of the cup of the coffee is 1.49, and the average variable cost per coffee is 0.36. Average fixed cost per month is 1,300, and 2,100 cups are sold each month on an average. What is the CM ratio for the coffee clutch? So this is a very simple example that you can do by yourself, right? So I'm just going to pause this and giving you some time. Okay, So the right answer here is, we know that contribution margin ratio, CM ratio, is a contribution margin. CM divided by SP means the selling price. So very simple. You can see this is the right answer. So look at the explanation here. So explanation says that the selling price minus variable cost is contribution margin divided by selling price. So in this way that we have calculated 0.758. So this is CM ratio. Now next, see that the cost volume profit relationship in the graphical form. So when there were 300 units and 400 units and 500 units, right? So these were the incomes available. That if there were the 300 units, that income was in minus, even that this company was not in position to cover the fixed cost rent of the building. It was not covered, right? It got it from maybe from the other lenders as a loan might have taken. Here it is covered. 400 units it is covered, but 500 units, no. Yes, there is a net profit. So this information can be obtained, right? So this graphs gives a manager a perspective that can be obtained in no other way. So consider this information, right? So this is one graph, cost volume profit graph. So cost volume profit graph is showing that the total expenditure here, that is a fixed, they are going to be fixed, nothing is going to change. It's a fixed expenditure means the fixed expenditure, nothing is going to change, right? So this is the fixed expenditure. The blue line is the fixed expenditure. We know that this is around 80,000. So 80,000 here is the fixed expenditure. Second, we have here the red line. So red line, which is showing here the total sale, right? So the red line is showing the total sale. So total sale means if there is 100 unit, right? So there will be a sale like this. So in this way, the sale is going on, right? So the sale is this much, which is increasing like that. So if there is a less sale here, if there is a less sale, this is the break-even point, but there is a less sale. The red one is the total sale. If this is a less sale, it means definitely this part will be the loss. If there is more sale, then there will be a profit. But that's it, nothing more than that. That you can see here very easily. Total sale that you can see here, and this is the break-even point. This is the loss area, and this is the profit. That we have done all these things practically, right? So we have done this practically. Now we can assume that we have some assumptions of CVP analysis. Selling price is a constant. Price will not change as the volume change. For example, we assume these things, right? That price will not change as the volume change, right? So price here means the selling price. The volume is changing, but we are not going to change any selling price. This is one of the assumption, and this is also true that if the one chair is selling at the rate of $250, for example, and whether the production is more or less, then selling price we are not going to change. And the second is the costs are linear and can be accurately divided into variable and fixed elements. The variable element is constant per unit. We know that the variable elements are the constant, the per unit. We cannot change it. as the production of chairs will increase, or here in this case of bicycle increase, then definitely the variable cost will also increase. Fixed element is the constant in the total over the entire relevant range. Relevant range. In the last class that we discussed about the relevant range, because if the step by step, if those steps 10 we took an example of a gym, 10,000 square foot area is there. If they want, there are a number of clients are coming and increasing, then they feel if there is a shortage of space, they need more space, and the more space is available in the 10,000 square foot, the next step will be the 10,000 square foot, then that will be the more cost, but that is known as the relevant range. Okay, at the relevant range, the fixed expenditure will remain the same. So in multi-product companies, it means there is no only one product, but there are different product. The sales mix is cost constant. In manufacturing company, inventory do not change, means number of unit produced is equal to number of units sold. It means in the manufacturing companies, whatever the production is done is equal to the all unit are sold, right? So they consider like this in manufacturing companies. Now, next is changes in the fixed cost and sales volume. So Wind is currently selling 500 bikes per month. The company sales manager believed that the increase of 10,000 in the monthly advertising budget would increase bike sale to 540 units. Should we authorize the requested increase in the budgeted advertising budget? This is the question, whether this is right or wrong, right? So what should they do? It means they are increasing some expenditure. Maybe the $10,000 they are increasing, and they are expecting some increase in the sale of bikes. So look at this. We see that no doubt $80,000 plus $10,000 advertisement or advertising is equal to $90,000. This is the expenditure. We know the left part, which is already known, and this is the projected sale is the 48 bikes increased, and this should be the sales, and the next should be the contribution margin minus the fixed expenditure, and the new one, and $18,000. It means the profit decreases. So it means sale increased by 20,000, no doubt, but the net income decreased by 2,000, which is not right. Because last time like 40 units were 40 units. For example, if you take an example of the 40 units only, the shortcut solution is the 40 units into 208,000 minus advertising cost 10,000. 2,000 is decreased in the net income. Now, the break-even analysis. If we talk about the break-even analysis, can be appropriated in two ways: equation method and contribution methods, margin method. So first one is equation method, and second one is contribution margin method. Okay, so look at the equation method first. Equation method is profit minus a sale. Profit is equal to sale minus a variable cost, variable expenditure plus a fixed expenditure. Variable expenditure plus fixed expenditure, we know this is the profit. So sale minus all the expenditure is known as profit. Or if we say the sale is equal to the sale that we have here, the profit, this is that we are going to add it here, right? So the sale is equal to variable expenses plus fixed expenses plus profit. Yes, exactly. So all the expenses plus profit is equal to sale. We can just think like that. 100 minus 100 is the sale minus the total cost. Total cost 80 is equal to 20 profit. If I add 80 plus 20, so this is 80 variable cost plus fixed, 80 plus 20 is equal to sale, one and the same thing. Okay, so sale is equal to expenses plus profit. This is expenses plus profit. So at the break-even point, the profit equals 0. So it means when the profit is 0 here, when the profit is 0, it means this is the break-even point. It means the sale is 80 is equal to 80. 80 is the cost. It is the cost of 1 and 2 both, total cost. So total cost is equal to sale. There is no profit at all. That is known as break-even point. So look at this equation method. Equation method says that 500 bikes that were sold here, and per unit that we know like 500 minus 300 is the costing, the variable expenditure, and we have the contribution margin, this one. So contribution margin is the 40% here on the sale. So this is the fixed expenditure. This is the equation method which already that we have done. Now, so next we are just going to calculate like this. So 500 is the quantity, Q is equal to 300 Q plus 80,000 plus 0, right? So in this case, what is happening here? The 300 is a rate. 300 is here a rate of the variable expenditure as per the Q. Q means the quantity. So here, let's say how many units that we have. So we are going to calculate this much. 500 and Q. 300 Q, right? And plus 80,000 plus profit. This is one we have for the break-even point. Then we can calculate like this. If I look at this, we need to calculate the quantity. How we can calculate the quantity here? We know that it's a 500 Q is equal to 300 Q plus 80 plus 5, and this is like a 200 Q is equal to 80,000. And the Q will be the 400 bike. So that we have calculated. So how the 200 has come? If the 300 is here, 300 that if we put it here on the left hand side, this is the plus figure that will be converted into the minus. So 500 minus 300 is equal to 200 Q. Plus 80,000 plus 0 is 80,000. So 80,000, this is the multiply and this will be divided here. So Q is equal to 80,000 divided by 200 is equal to 400 bikes. 400 bike. Right. So now we can also use the following equation to compute the break-even point in sales dollar. Like this, the sale is equal to variable cost plus a fixed expenditure plus profit. So just like this, like 0.60x is the variable expenditure that we know, 60% that we saw on the previous slide, plus 80% and 80,000 plus 0, where x is what? X is the total sale dollars. The total sales in dollar, because x here is the dollar amount. So amount like 60% of this. 60% of this was the variable cost. We know that, right? And fixed cost already that we know. Profit we have seen 0, right? So the x here is what? This is the total sale. So total sales is 60% is variable. So now in this way, with this formula, we can calculate the quantity for the break-even point. So let's see slowly that we are going to calculate. So 80,000 that we have, x here is x minus 0.60 is equal to 0.40, x is equal to 80, and x here is equal to 80,000 divided by 0.40. This is x is equal to 200,000. So 200,000 is what? 200,000 is sale. X is equal to sale. It means 200,000 is the sales here. Now look at this. The contribution margin method is a variable of the equation. So break-even point unit sold is we know that a fixed expenditure and CM. Very simple. Fixed expenditure divided by the contribution margin. So break-even point will be fixed expenses plus CM ratio, we can say. Okay, so look at this. This is one of the example in front of you. What you need to do, you need to find out the break-even sales in units. It means the formula that you know, the fixed cost divided by contribution margin, CM, F divided by CM. So this is your turn. You need to calculate these figures. So I'm just giving you some time, around like take like 5 to 10 minutes, and calculate and let me know what is the right answer. Okay, so what is the break-even sales in unit? The right answer here is 1150 cups, right? If like these cups are coming in fractions, no problem that you can take it like this one. So we know that 1300 divided by 1.13, so that will be 1150, right? So that this much of cups they need to sell, so that will be the break-even point. So that will be the break-even point. So we will continue this session. So for today, till this point, it's all done.